93.59. That is the number of Indian rupees it now takes to buy a single US dollar, an all-time low. The rupee was Asia's worst-performing currency in 2025, falling roughly 5.5% against the dollar. And yet, during that same period, India attracted a record $80.62 billion in foreign direct investment. Apple announced plans to produce $34 billion worth of iPhones in India by fiscal 2027, and Prime Minister Modi signed what the White House called a historic trade deal with President Trump. The rupee is falling, the money is flowing in, and the Reserve Bank of India's new governor is caught in the middle of the most complex monetary policy environment in Asia.
That is a fascinating contradiction. The currency is weakening, but the investment thesis is strengthening. How do those two things coexist?
They coexist because they are driven by different forces that are pulling in opposite directions. Let me walk through each. The rupee's weakness has multiple drivers. First, the US dollar is strong globally. The dollar index remains elevated because the Federal Reserve has kept rates higher for longer than most other central banks. Second, US-India trade tensions pushed the effective tariff on Indian goods as high as 50% at one point in 2025, which created uncertainty about India's export competitiveness. Third, portfolio capital has been flowing out of India. Foreign institutional investors have been net sellers of Indian equities, partly because valuations on the Nifty and Sensex were stretched by historical standards.
And the RBI has been cutting rates, which puts additional pressure on the currency.
Exactly. This is where the policy tension gets really interesting. Sanjay Malhotra took over as RBI governor in December 2024, and he has overseen a cumulative 125 basis points of rate cuts since early 2025. The repo rate now stands at 5.25% after the most recent February 2026 decision, where the MPC held rates unchanged with a neutral stance. Governor Malhotra noted that headline CPI inflation is below the 4 to 6% tolerance band and remains benign, which gives the RBI room to support growth. But every rate cut widens the interest rate differential with the US, which puts downward pressure on the rupee.
So the RBI is cutting rates to support domestic growth, but that makes the currency weaker, which could increase import costs and push inflation up. It is a circular problem.
That is the classic emerging market central bank dilemma, and India is navigating a particularly sharp version of it. The RBI has historically been one of the most active currency managers among major central banks. They intervene in the foreign exchange market using their reserves, which stand at roughly $620 billion. But CNBC reported in December that the RBI's support for the rupee appears to have softened after the currency breached 88.80. Some market participants interpret this as a deliberate decision to allow more depreciation rather than burning through reserves.
Now, let's talk about the trade deal, because that seems like it should be a positive for the rupee.
On February 2, 2026, Trump and Modi announced what both sides called a historic US-India trade deal. The White House published a fact sheet outlining the key terms. The US would lower its reciprocal tariff on India from 25% to 18%. Trump also agreed to remove the additional 25% tariff that had pushed the effective rate to 50%, in exchange for India's commitment to stop purchasing Russian Federation oil. India committed to purchasing $500 billion in US energy products, aircraft and aircraft parts, precious metals, technology products, and coking coal over the next 5 years.
$500 billion over 5 years. That is $100 billion per year.
Which is an extraordinary number, and one that many analysts view with some skepticism. CNBC published an analysis titled "Devil in the Details," noting that the deal raises hopes for a reset, but the fine print remains unclear. Carnegie Endowment published a piece arguing that the deal will not magically restore US-India trust. The framework is an interim agreement. The actual bilateral trade agreement negotiations have not been completed. The tariff reduction from 50 to 18% is significant and immediately positive for Indian exporters, but the conditions attached, particularly the Russian oil commitment, have domestic political implications in India.
How has the market responded to all of this?
Mixed. The trade deal initially provided some rupee support, but the currency resumed its decline because the structural drivers, dollar strength, capital outflows, rate differentials, have not changed. The equity market has been more positive, pricing in the benefits of lower tariffs and increased FDI. But the rupee at 93.59 tells you that the currency market is focused on flows and rates, not headlines.
Let's dig into the FDI picture because the numbers are genuinely impressive.
India's FDI in fiscal 2024-25 hit an all-time high of $80.62 billion, and the expectation is that 2026 will exceed that. The investment commitments from global tech companies are staggering. Microsoft has committed $17.5 billion by 2030 for AI infrastructure. Amazon is investing $35 billion over 5 years across quick commerce, cloud computing, and artificial intelligence. Google is putting in $15 billion over 5 years to establish an AI hub. Apple and its suppliers are targeting 32% of global iPhone output assembled in India by fiscal 2026-27, with production value potentially reaching $34 billion.
Those are enormous numbers. And there's the semiconductor story we covered a few episodes ago.
India's semiconductor market is projected to reach $55 billion by 2026. The Union Budget 2026 introduced comprehensive tax exemptions and duty-free incentives specifically aimed at semiconductor and electronics manufacturers. We covered the Tata PSMC fab in Dholera and the Micron facility in Sanand in our India semiconductor episode. Those are progressing. And there's a broader shift happening. India Briefing reported that India is quietly relaxing its restrictions on Chinese investment in electronics manufacturing, recognizing that the supply chain cannot be built without Chinese component suppliers. Digitonics reported that India is positioning itself as a key hub for semiconductors, clean energy, and advanced manufacturing.
So the investment case for India is clear. Why is the rupee not reflecting that?
Because FDI and portfolio flows operate on different timelines and respond to different signals. FDI is long-term. Apple building a factory or Micron constructing a fab are multi-year commitments. They do not reverse based on quarterly interest rate decisions. Portfolio flows, foreign investors buying and selling stocks and bonds, are much more sensitive to short-term factors like interest rate differentials, currency expectations, and global risk appetite. India has been experiencing significant portfolio outflows even as FDI hits records. The two flows are pulling the rupee in opposite directions, and in the short term, portfolio flows tend to dominate currency movements.
What about India's current account deficit? Because that's another fundamental driver of currency direction.
India's current account deficit has actually narrowed significantly. It is running at roughly 1% of GDP, which is very manageable by historical standards. India's import bill has come down, partly because of lower oil prices and partly because of the trade deal's energy import commitments, which lock in long-term supply agreements. The structural current account position is not the problem. The problem is capital account flows, specifically the hot money that moves in and out based on relative returns. When U.S. Treasury yields are higher than Indian government bond yields on a risk-adjusted basis, capital flows toward the U.S. That is what has been happening.
Governor Malhotra is in a tough position. He wants to cut rates to support growth, but every cut makes the capital outflow worse.
And he has an additional consideration that his predecessor did not face as acutely, the Trump trade deal. The deal includes India committing to $500 billion in U.S. purchases over 5 years. That means India needs to run larger trade deficits with the United States, which puts additional structural pressure on the rupee. The deal is designed to benefit both countries, but the currency impact is asymmetric. India is the one making the dollar-denominated purchase commitments.
How does the RBI manage all of these competing pressures simultaneously?
The toolkit is limited. The RBI can intervene in the forex market using its reserves, and it has been doing so, spending tens of billions of dollars to smooth the rupee's decline. But reserves are finite, and burning through them too aggressively sends a signal of desperation that can actually accelerate the sell-off. The RBI can use macroprudential tools, adjusting reserve requirements, managing capital flow regulations to slow outflows, and it can try to attract more stable capital by maintaining credible inflation targeting and fiscal discipline, which makes Indian assets more attractive on a long-term basis.
The credibility factor is interesting because India's inflation is actually under control right now.
Governor Malhotra specifically highlighted that headline CPI is below the tolerance band and core inflation remains benign. That is the bright spot. India is not facing a classic emerging market currency crisis where inflation is spiraling and the central bank is losing control. The fundamentals are actually quite strong. GDP growth above 6%, fiscal deficit narrowing, inflation contained, FDI at records. The rupee weakness is more about global capital flow dynamics and dollar strength than about India-specific problems. But the market does not always differentiate between those causes.
Contrarian corner. The consensus view is that the falling rupee is a problem. It signals weakness, it increases import costs, it hurts consumer purchasing power, and it creates a policy headache for the RBI. What is the skeptical read?
The contrarian position is that rupee depreciation is not just acceptable, it is actually beneficial for India's strategic economic goals. Here's the argument. India's #1 economic priority right now is to become the world's next great manufacturing hub. The entire China Plus One strategy, Apple moving production to India, Samsung expanding factories, Tata building semiconductor fabs, depends on India being cost competitive with China and Vietnam and Indonesia. A weaker rupee makes Indian manufacturing cheaper in dollar terms. It is effectively a subsidy to the export sector without the government having to spend a single rupee.
So you are saying the rupee falling to 93 actually helps India attract more manufacturing investment?
That is exactly what I'm saying. Consider it from Apple's perspective. Apple wants to produce iPhones in India. The cost of Indian labor, factory space, and components is denominated in rupees. Apple sells iPhones globally in dollars, euros, and yen. When the rupee depreciates from 85 to 93 per dollar, roughly a 9% decline, the dollar cost of Indian manufacturing falls by 9%. That makes India more attractive relative to Vietnam, where the dong has been more stable, or relative to Mexico, where the peso has actually strengthened in some periods. Currency competitiveness is a direct input into manufacturing investment decisions.
That is a compelling argument, but doesn't a weaker rupee also make imports more expensive? India imports a lot of oil and electronics components.
It does, and that is the trade-off. India imports roughly 80% of its crude oil, so a weaker rupee pushes up the cost of fuel, which filters through to transportation costs and consumer prices. But here is the nuance. Oil prices have actually declined from their 2022 peaks, which partially offsets the currency impact. And the US-India trade deal includes long-term energy purchase commitments that could provide some price stability. The net effect on India's import bill depends on the interaction between currency moves and commodity price moves, and right now those two forces are partially offsetting each other.
What about the impact on Indian consumers? Because for the average person, a weaker rupee means everything imported is more expensive.
This is where the distributional question gets interesting. The average Indian consumer's basket of goods is heavily domestic: food, housing, local services. Imported goods make up a relatively small share of consumption for most Indian households, especially outside the urban upper middle class. The people most affected by rupee depreciation are the wealthy who buy imported electronics, luxury goods, and foreign travel. The people most benefited by manufacturing-driven job creation are working class and lower middle class workers in manufacturing-adjacent industries. So there is actually a progressive distributional effect. The gains from manufacturing investment go to the workers who need them most, while the costs of a weaker rupee fall disproportionately on the wealthy.
That is a really interesting reframe. But surely there are limits. You cannot let the currency fall indefinitely.
Absolutely, and this is where the RBI's role becomes critical. The contrarian position is not that the RBI should abandon the rupee and let it fall without limit. It is that the RBI should manage the pace of depreciation, ensuring it is orderly rather than disorderly, while allowing the direction to be market-determined. The difference between orderly and disorderly depreciation is enormous. Orderly means a gradual decline that the market expects and can adjust to. Disorderly means a sudden crash that triggers panic, capital flight, and financial instability. The RBI's reserves of $620 billion give it the firepower to ensure orderly adjustment. The question is whether they use that firepower to fight the market or to smooth the market's direction.
And the evidence from early 2026 suggests they have shifted from fighting to smoothing.
That is my read. The decision to soften intervention after the rupee breached 88 suggests Governor Malhotra has made a strategic choice to allow gradual depreciation while maintaining enough intervention to prevent disorderly moves. This is actually sophisticated central banking. The worst outcome would be to defend the rupee at a level that the market considers unsustainable, burn through reserves, and then be forced into a sharp devaluation anyway. Better to manage the adjustment proactively.
How does this compare to how other Asian central banks are handling similar pressures?
Bank Indonesia has faced similar dynamics. The rupiah has been under pressure for similar reasons, but Indonesia's reserves are smaller and its current account is more vulnerable, so they have less room to maneuver. The Bank of Japan is in a completely different position. They have been tightening policy to support the yen, which has strengthened from its 2024 lows. South Korea's won has been volatile, partly because of the political crisis. Among the major Asian economies, India's combination of strong fundamentals, large reserves, and deliberate policy management actually positions the RBI relatively well, despite the headline currency weakness.
Action items. What should investors and business operators track here?
3 action items. First, track the RBI's foreign exchange reserve levels and intervention patterns as the most direct indicator of the central bank's strategic stance. India's reserves are currently around $620 billion. If reserves start declining rapidly, say losing more than $5 billion per month consistently, it signals the RBI is fighting the market aggressively, which is typically unsustainable. If reserves remain relatively stable while the rupee continues to weaken, it confirms the orderly depreciation thesis, that the RBI is managing pace rather than direction. The RBI publishes weekly reserve data, so this is a high-frequency signal. Also watch the forward premium in the rupee swap market. If the premium compresses, it means the market expects less depreciation going forward.
The second action item?
Monitor the US-India trade deal implementation timeline and the specific tariff schedule as a medium-term driver of both the rupee and FDI flows. The White House fact sheet outlined the framework, but CNBC's devil in the details analysis correctly noted that the fine print is still being negotiated. The tariff reduction from 50% to 18% is the headline, but the phase-in schedule, the product exemptions, and the enforcement mechanism for India's $500 billion purchase commitment are what actually matter. Watch for the formal bilateral trade agreement text, expected to be finalized through 2026, and compare the actual tariff reductions with the announced headline. Any delays or watering down of the tariff cuts would be negative for both the rupee and Indian equity sentiment. Conversely, faster than expected implementation would be a significant positive catalyst.
Third,
focus on the manufacturing investment pipeline as the metric that determines whether India's weak rupee is a bug or a feature.
The key numbers to track are Apple's quarterly India production data. They have been increasing the share of iPhones assembled in India, and the target of 32% of global output by fiscal 2027 is ambitious. Watch Foxconn's India hiring announcements and factory expansion plans, which we covered in our Foxconn episode. Track Samsung's display and semiconductor investment decisions for India, and monitor the semiconductor fab projects, Tata PSMC in Dalera and Micron in Sanand, for construction milestones and timeline adherence. If the manufacturing investment pipeline accelerates despite or because of the weaker rupee, it validates the contrarian thesis that currency depreciation is supporting India's strategic transformation. If manufacturers start signaling concerns about currency instability or pulling back commitments, the rupee weakness becomes a genuine risk.
The three signals are RBI reserve management as a central bank strategy indicator, trade deal implementation as a medium-term catalyst, and manufacturing investment pipeline as the test of whether rupee weakness helps or hurts India's transformation.
And the overarching insight from today's episode is that currency weakness and economic strength can coexist, and in India's specific case, they may actually be complementary. The rupee at 93 per dollar is uncomfortable to see as a headline, but if that level of currency competitiveness is what it takes to shift global manufacturing supply chains toward India, to get Apple, Samsung, Micron, and dozens of other multinationals to build the factories that create millions of jobs, then the trade-off may be worth it. Governor Malhotra's challenge is managing that trade-off without letting the depreciation become disorderly or inflationary. So far, the evidence suggests he is navigating it reasonably well.
The story of India right now is really about the tension between short-term pain and long-term gain. The rupee is the short-term pain, the manufacturing transformation is the long-term gain, and the RBI is the institution trying to hold both of those things in balance.
And if you want the full written breakdown with the RBI policy analysis, the trade deal details, and the FDI pipeline data, it is in today's newsletter at asiatechmacro.substack.com. In our next episode, we are looking at the global AI regulation race, how the EU's AI Act, China's algorithm laws, and Japan and Singapore's governance frameworks are creating fundamentally different regulatory environments for AI companies operating across Asia, and what this regulatory fragmentation means for the companies trying to build cross-border AI products, regulation as the new competitive moat.
That is a topic that ties together so many threads we've been covering.
Stay data-driven. Bye.